What is going on, traders? Jam-packed show for you today, but don't we always have one? Tesla, Microsoft earnings, of course, we're going to talk about that. These are the list of topics that we're going to cover, but earnings really are going to dictate what the market does in the short term, but more importantly, what the Fed is likely to do on February 1st. We're going to go over some trade recaps, and then GDP, Q4 GDP came out today, unexpectedly high. However, there is the PCE measure within that GDP report. Remember, PCE is the Fed's supposed preferred inflation gauge, and we're going to take a look at that and see whether the Fed actually thinks this is a good GDP report, meaning one that will allow them to loosen up their policies a bit more or think of loosening policies a bit more, or whether they're going to get more aggressive. And then that adage, don't fight the Fed. The only problem is nobody knows what the hell the Fed is going to do on February 1st. All of the bets signal that the Fed is going to come out with a 25 basis point rate hike. However, we dig deeper into the bond market and you will see that bond traders just do not trust that the Fed are going to keep rates higher for longer. So we will take a look at all of the metrics showing what the bond traders actually think the Fed is going to do. And then because it is a Thursday, we will get into some charts, which you guys seem to love. So let's get right into it. So the market has been flip-flopping the last few days, obviously because Microsoft came out with okay earnings. They always beat out earnings. However, their guidance was pretty weak compared to what the Wall Street expectations were. But then Tesla came right back, reporting record revenue and beating on earnings, also showing that gross margins, yes, came in pretty low, and that is partly due to the price drop. However, really, in a recession, I think all the market cares about is, can you put cars in people's garages? And I think Tesla can do that better than any car company at the moment while still making a profit and still recording record revenue of 24.32 billion. Elon Musk on the call said that Tesla also has the potential to do 2 million cars this year. And they did not issue new guidance. So they were able to really duck the guidance bullet. And you saw Tesla shares surge 11% the day after earnings. And you finally see the market breaking out of this trend line comfortably, a trend line that it was flirting with up and down throughout the last couple of weeks, really, but breaking out of that year-long trend line. However, know that breaking out of a trend line doesn't necessarily mean you're out of the woods. It just means for now, the market is starting a short-term trend. And as I said before, if earnings and guidance continue to be seemingly unaffected by high interest rates and by a potential recession, then 4,300 is really on the table. And I know that some of you novice traders and investors don't like when I give a bull and a bear case, but that is the point of analysis. You're not trying to make a bold prediction and then dig your heels and stick to it no matter what. You're trying to really lay out conditions for, hey, what could happen if X happens? Or what could the outcome be if Y happens, so that you're better prepared? And trust me, I would much rather see the market surging. I wish we get back to all-time highs tomorrow. I would much rather see the market surging than any of my hedges or my shorts play out, because my long-term portfolio is way bigger than any hedge that I would ever take. And I suggest that people do that as well. However, do what you like. All right, so some trade recaps, then I'll get into the GDP, and then we will get into this. Will the Fed come back and slap the market down for daring to go above this trend line? Will it slap the market down for that 2.9% unexpected GDP number? We will talk about that. So in terms of trades, as I stated in my last video, I did have hedges against the triple Qs, against a SPY, which obviously are currently down against this trend line. Our long-term portfolio and also my Tesla position looking sweeter than candy. And on Tesla, we had this double butterfly position where if Tesla tanked on earnings or surged on earnings, we make money both ways. And for me, based on where Tesla's implied volatility was, that was the best play. The only real killer is if Tesla had stayed in the middle. So we are going to make money on this regardless, most likely. This expires tomorrow as of the time of this video. And with regards to Tesla stock, I said on Twitter, by the way, follow me on Twitter and Instagram. I send daily trading and finance content. I send a lot of trade ideas and chart analysis as well. completely free. But I said, if you really wanted to own Tesla stock and 75% down wasn't enticing enough, face it, you were never going to buy it in the first place. And I say these things, and I've been saying that really since October, because I know how this stuff goes, right? I've been through three bear markets now, three major bear markets and recessions now in my adult life. And I can tell you without a shadow of a doubt, the same thing happens all the time, is that people just wait and wait and wait and wait, thinking that somehow they're going to capture the bottom. They really don't have a good criteria for when the bottom is going to be, because guess what? Nobody does. Even advanced economists and analysts don't know. And so if your stock, is trading at 101, 75% down, and it's a stock that you want to own, and you didn't buy it, well, now you're forced to make a decision whether you want to buy it at 50% higher than it was just a couple of weeks ago. But most retail investors who have this mindset where they're not comfortable buying in the red and they want some security before buying, they normally are the ones that get left out, and they're the ones that end up buying, back during the next bull market when the market is making fresh highs. And by the way, I'm not saying that you should have known this was the short-term bottom for Tesla. I'm saying that if Tesla is a stock you wanted to own and it's 75% down, how much more downside are you looking for? As I posted on January 6th, I said, I'm being asked a lot about whether I'd invest in Tesla. Now, what people are really asking is, can you please confirm that this is the bottom? Because I want to catch it. Nobody asked this when they bought at 300 plus. And I said, frame your approach differently. What is Tesla's realistic downside versus upside here? 25% more downside versus 150 upside? If you think this, how can you justify not investing? And obviously, I got a ton of comments, some supportive, some saying, we're not over yet. Why are you encouraging people to buy? The bear market is not over. Hell is coming, etc. Well, look, I can only deal with the facts in front of me. If there's a company that I want to buy that I believe in and it's 75% down, that is a fact because it's already happened and I'm staring at the price right now. Versus if there is a potential downturn where I don't know if I'm going to be right or not, I'm not going to risk giving up the opportunity to buy a company that I want to own for the sake of being some sort of Nostradamus. And even if you're right on that Nostradamus proposition, how much more downside is there for Tesla, right? Like, what are we talking about here? Unless you think the company is going to zero, that's a different story. But then I think there are more problems to contend with at that point, right? Anyway, rant over. I will get back into the market analysis when we talk about TA at the end of the video. What is next on the docket? And by the way, if you want access to all of our trades and analysis in real time, link is in the description below. Be sure to sign up. Not only do we send out our analysis, futures trading, options trading, like for instance, we bought the 0 days to expiration 39.90 SPX put today when we were retracing into a very important level here. We're able to jump out with 115% on those SPX options. Also, make sure if you're watching this before January 28th, sign up for our free mastermind webinar. This is going to be absolutely free. Space is limited. We're almost filled up because we're limited by the number of seats in Zoom. So it's going to be January 28th at 12 p.m. Eastern time. So make sure you sign up. If you want to jump in on that, you'll see the link down below in the pinned comment. All right. So Q4 GDP has grown past expectations, 2.9% annual rate, which is stellar. However, we are definitely in this weird time where, there are a lot of recessionary indicators popping up, but then we also see that unemployment is at a 50-year low. So the labor market is still really tight. We still have wage inflation, but prices are dropping because we see PCE and CPI dropping as well. And right on the surface, it looks like the Fed is actually going to take this and use this as a way to get hawkish, meaning potentially a pretty aggressive rate hike in the next cycle, as well as language signaling that they're not going to stop anytime soon. However, lo and behold, after that GDP number came out, the chances of a 25 basis point rate hike, if you look at the Fed funds rate futures, has actually increased and it's almost at 100%, 99.1%, that next week, February 1st, the Fed is going to do a 25 basis point rate hike. We are going to be live, by the way, on that day. So be sure to tune in with us then. However, that this is kind of ludicrous because you're like, wait a minute, the GDP grew at a rate that the Fed, neither the Fed nor analysts had expected. So doesn't that mean that the Fed now has impetus to go higher than 25 basis points? Why are market makers betting that the Fed is going to stick to that 25 basis points? Well, if you drill down into the GDP, you will see something that will really excite the Fed here. Excite the Fed. Do you guys remember that Nas song from Illmatic called Halftime? He said, I wear chains that excite the Feds. Anyway, all right. So the PCE price index increased to 3.2% compared with an increase of 4.3% the previous quarter. And excluding food and energy prices, PCE increased 3.9% compared with an increase of 4.7% the previous quarter. So this right here, the Fed is going to look at more than the actual GDP itself. And if you drill down into the GDP, you'll see that it's not all peaches and cream. A buildup in inventories and the impacts of foreign trade were significant factors that led to GDP coming in so strong. Obviously, these are not sustainable growth factors, right? We're talking about things that are not that might, numbers wise lead to a better GDP number, but are not things that you really want to see in a detailed report. So lastly, what does that mean the Fed is going to do? Well, if Fed fund futures bets are any indication, and they've rarely been wrong, the Fed is likely going to do a 25 basis point rate hike come February 1st. And what the market will be looking for is language on whether the Fed is going to pause or not. So I think that they can play the language game here, and instead of acting aggressive by hiking more than they really want to, they will hike 25 basis points and then keep the aggressive language in their speech, saying that, no, what are you guys talking about? Pausing? We don't see any pausing. We might pause at some point and then keep rates higher for longer, but we don't see any easing of monetary policy. I don't know where you got that idea. And bets all across the board, from SOFR futures to 10-year futures to 2-year futures, indicate that the market thinks that the curve is actually going to start steepening once again between the 10-year and the 2-year, between the 10-year and the 3-month. In other words, acting more like normal, because remember, those yield curves have inverted quite a bit over the last year, to a point in some of the yield curves, like the 10-year and 3-month, the most inverted yield curve we've ever seen. So a lot of a lot of bond futures bets are coming in, suggesting that the 10-year is actually going to start rising again, and that the short-term rates are actually going to start dropping. Because remember, short-term rates are really the ones that are the most affected by the Fed. So if the Fed is not going to be raising interest rates much longer, then the market is betting that the short-term rates fall and that the long-term rates, the 10-year, for instance, rises. And this is the weekly chart of the 10-year. And you could see actually that the yield is at this major trend line that we've been holding for over a year. So the bet is that the actual yield is going to go up and that the short-term yields are going to go down, thereby actually steepening the yield curve and returning it to somewhat of a normal status. I myself am likely going to take the 10-year note future short. Remember, there's an inverse relationship between yields and bond prices. So when you are short the yield futures, that means you're expecting bond prices to go down and the yields to go up. So the 10-year T-note futures are denoted by the ticker symbol ZN. And this is actually what I'm likely going to take short soon. It's going to be a very short-term play, but I'm likely going to take the short very soon because of the institutional bets that we see doing the same, and because I think that the Fed is actually going to not really entertain hiking for much longer this year. And if you drill down even further into the SOFR futures, I'm not going to explain in detail what that is, but it is the overnight funding rate. The SOFR futures are pricing in that the Fed is going to cut by 50 basis points this year. And if you're asking me what I do think that the Fed is going to pause very soon, either after February or March. Anytime that the 2-year note gets below the Fed funds futures, you can see here the blue lines that the Fed actually holds these rates for longer. We see this back in 2000. We see this back in 2007. And we even see this back before the 2020 pandemic, where the 2-year note gets below the Fed funds rate, and then the Fed actually holds those rates, waits for things to break before actually reversing. So the market is betting that all of that happens within the span of 2023. It's still January. So they're betting that in the first half of 2023, the Fed pauses. Second half of 2023, the Fed actually starts cutting rates because things are going to start breaking in the economy and we will be in a full-fledged recession by then. So, I don't know if I would go that far as to say that we're going to cut by 50 basis points. I do think it's very possible, but I do think for sure by first half of 2023, we will get a pause. Now, as I stated before, we're going to be doing, before we close out the video, just a little bit of TA here. I do think that 4,300 level, if we continue to get decent earnings and guidance, especially in companies that are left to report like Apple and Amazon and Alphabet, all the oil companies, that 4,300 is a very doable target, especially now that we're comfortably out of this trend line here. I'm going to wait until Friday, January 27th in order. Actually, you know what? I may hold these shorts until the FOMC meeting, to be honest, which is February 1st. Like I said, my long-term portfolio is way more important to me than these hedges. And so I'm okay holding these hedges. I might hold it until February 1st to see if the Fed actually gets aggressive or not. I don't know. I'm undecided on that. Definitely not going to open any new short positions here, although I did buy puts on Intel just because that's a piece of shit company that always tanks after earnings. But I do think 4,300 is very viable before the market actually does another reversal. I don't think the extent of earnings compression is really priced in yet. I do think some stocks went far below where the economic circumstances dictate. Like, I do think that Tesla going to 101 was far below where it should have traded. It can still go lower. It just, really has to be backed up by an earnings compression story. And right now we are not getting that story out of most of the mega cap companies, right? And so it might be a long road before we do see another decline. And remember, the stock market can also trade in a very ugly manner sideways. However, I do think 4,300, if we do get, most of the rounds of earnings, positive guidance, the market is not going to go down. The market is going to go down if there is an expectation that earnings is really going to compress, which right now companies are not showing proof of. So the market is happy to spend that money on those companies. However, if we do get negative earnings and guidance, and Tesla was really the anomaly, and on February 1st, we do get hawkish talk from the Fed, then this will have been a swing failure pattern, and I think we will fall back down in the trend line again. Again, there is a bullish and bearish case. Your job is to focus on companies that you want to buy at prices that you want to buy them, and don't worry if that's the bottom or not. That is how traders and investors lose money in the long term. Anyway, traders, that is it for this video. If you got anything out of this video, leave it in the comment section below. Let me know what you think of this. Is this a swing failure pattern? Are we going to continue back down in the trend line? Is Jerome Powell going to come out hawkish or dovish on February 1st? What do you think of the upcoming earnings that have not yet been reported? Is 2023 going to get uglier? Are we going to go into a recession or not? Let me know in the comment section down below. If you want access to all of our plays, our analysis, long-term, short-term, futures, options, you want access to all of the courses, the day trading course, the options course, the Zoom calls with me, make sure to sign up. Link is in the description below. Sign up for the free webinar January 28th if you want to see what we're all about. That link is also in the pinned comment below. Stay safe out there, traders. Peace.